Hey everyone, welcome back. Today we're diving into a topic that has a lot of investors scratching their heads.
Yeah, it's definitely a head scratcher.
Stocks versus bonds. And specifically, we're going to look at why some major firms, like Vanguard, are suggesting we move away from that classic 60-40 portfolio.
It's a pretty big change, right? I mean, for years, that 60% stocks, 40% bonds allocation has been the gold standard.
The holy grail, basically. But now Vanguard's saying, hold on, maybe a 40-60 split, heavier on the bonds, is the way to go in the current market.
It's a pretty big flip, and I think a lot of people are wondering, what gives? Have bonds suddenly become the rock stars of investing?
Right, what's the deal?
Well, it's not that bonds are suddenly better than stocks. It's more about a shift in market dynamics. We're talking about the relationship between stock earnings yields and bond yields.
Okay, let's unpack that a bit. Earnings yield, that's essentially how much profit a company is making compared to its stock price.
Exactly. Think of it like this. If a company earns $10 per share and the stock's trading at $100, that's a 10% earnings yield. For every $100 you invest, you're getting 10 back.
Okay, so how does that tie into bonds and this whole portfolio shift?
Well, the bull market we've seen recently pushed stock prices way up.
And when prices go up?
Earnings yields go down. At the same time, bond prices have been dropping, so their yields are going up.
Interesting. So before we go any further, if you're liking this breakdown so far, hit that like button and subscribe to the channel. We've got a lot more to cover, so stay tuned. Now, you were saying that bond yields are rising.
Exactly. And a lot of the analysis you see out there compares the earnings yield on the S&P 500 to the interest yield on a 10-year Treasury bond. But that's not the whole story.
What's missing from that picture?
We need to consider inflation. Stocks, generally speaking, give you a real return. That means a return that's keeping pace with inflation.
Right, you're staying ahead of the game.
But bonds, especially those regular treasuries, don't always do that.
So to make a fair comparison, we should be looking at the S&P 500 earnings yield against something that adjusts for inflation, like TPS, those Treasury inflation-protected securities.
Exactly right. And when you make that comparison, it starts to become clearer why Vanguard is suggesting this portfolio shift. Right now, stocks are offering a lower real return than they have historically.
Meaning you're not getting as much bang for your buck.
Right. It's about 3% now compared to their historical average of over 6%.
So that's on the stock side. What about TIP?
TIPS are currently offering a real yield of just under 2.5%.
Huh, so almost 2.5% after inflation is factored in.
Exactly. And that might not sound huge, but remember, just a couple of years ago, we were seeing negative yields on TIPS.
Negative yields, wow. So while we all expect stocks to outperform bonds over the long run, the difference, that so-called premium, is pretty small right now.
That's the crux of Vanguard's argument. They're saying it might be smarter to tilt your portfolio more towards bonds to snag those improved yields, but keep some exposure to stocks for potential growth.
Okay, that makes sense. But here's where I think it gets a little confusing for a lot of people. The world of bonds is a bit of a jungle.
You're not wrong.
There are so many different types of bonds out there.
Oh, yeah.
Where do you even begin?
You're right. It can seem overwhelming, but really, there are a few key things to consider: duration, credit risk, and inflation protection.
All right, let's break those down. Starting with duration. What is that exactly, and why does it matter?
Duration is basically a measure of how sensitive a bond's price is to changes in interest rates. Think of a seesaw.
Okay, I'm picturing it.
A bond with long duration is like a really long seesaw. Even a small shift in interest rates will cause a big swing in the price.
So it's very sensitive.
Exactly. A bond with a short duration, well, that's like a short seesaw. It takes a bigger move in interest rates to really make a difference.
Got it. So if interest rates go up, a long duration bond will drop in price more than a short duration bond, right?
You got it. So if you think interest rates are headed north, you might want to lean toward those shorter duration bonds. Helps limit potential losses.
Makes sense. What about credit risk? That one seems pretty straightforward, but I'm sure there's more to it than just risky versus safe.
Definitely more to it. Credit risk is all about how likely it is that whoever issued the bond, whether it's a company or government, will actually be able to pay back the principal and the interest.
So it's the risk of not getting your money back.
Right. U.S. Treasury bonds, they're considered the safest bet.
Backed by the full faith and credit of the U.S. government?
Exactly. Then you've got corporate bonds, which come with a range of risks. It all depends on the financial health of the company.
Okay, so some companies are more reliable borrowers than others?
Right. And then there are the high-yield bonds, sometimes called junk bonds.
Ah, yes, junk bonds.
These are issued by companies with, shall we say, less than stellar credit ratings.
So higher risk of default.
You got it.
Reminds reminds me of the whole mortgage-backed securities situation back in 2008.
Oof.
Those were initially rated as safe investments, and then boom, everything went south. Must have been a nightmare for a lot of bondholders.
Absolutely. And that's why diversification is so crucial, especially when it comes to bonds. You don't want to have all your eggs in one basket.
Spread the risk around.
Exactly. Invest in bonds from different issuers with different credit qualities. It helps to manage that risk.
So even within your bond portfolio, you want a mix of things.
Exactly. Don't just stick with all treasuries or all corporate bonds from one particular industry. Mix it up. And that brings us to the third factor, inflation protection.
Right, we touched on TPS earlier, but how do they fit into the bigger picture of bond investing?
Well, we talked about how those nominal bonds, like the standard treasuries, pay a fixed interest rate.
So you get your principal back in the same dollars you invested.
Right, but inflation can really eat away at the purchasing power of those dollars over time.
So if inflation is high, the interest payments from a nominal bond don't go as far as they used to.
Exactly, and that's where TPS come in handy. Their principal and interest payments are adjusted for inflation based on the consumer price index.
So if inflation goes up, the value of your principal and the amount of interest you receive, they both go up too.
Precisely.
That sounds like a pretty sweet deal if you're worried about inflation chipping away at your returns.
It's a great way to preserve your purchasing power in the long run. The key is to figure out what you think inflation will do in the future and choose the bond that fits your outlook.
So it's not just about stocks versus bonds. We're talking about nominal versus real returns too.
Right.
And within the bond world, you have to think about duration, credit risk, inflation, and of course, your own risk tolerance and time horizon.
Absolutely. There's no one-size-fits-all approach to bond investing.
Well said. And before we move on, I just want to remind everyone to hit that like button and subscribe to the channel if you're finding this helpful. We've got a lot more to cover on this topic, so stick around. Now, you mentioned diversification being really important. And so far, we've been talking about individual bonds. But what about bond funds? Are they a better option for most investors?
That's a great question, and it's a common misconception that owning individual bonds somehow protects you from market volatility better than a bond fund does. But that's not really the case.
So you're saying my investments will still go up and down even if I own a bunch of different bonds in a fund?
Absolutely. No matter if you hold one single bond or a whole basket of bonds in a fund, their prices will change as interest rates move.
Okay, that makes sense.
Yeah.
So how do I choose between buying individual bonds or investing in a bond fund? What are the main things to consider?
Well, it really boils down to a few key factors: timing, diversification, and costs.
All right, let's take those one by one, starting with timing. What do you mean by timing in this context?
Sometimes people invest in bonds because they have a specific financial goal in mind, like maybe saving for a down payment on a house in a few years or for their child's college tuition down the line.
So if I need a certain amount of money at a specific time, I could buy a bond that matures around the same time.
Exactly. You're syncing up the maturity of the bond with your financial goal. Individual bonds give you that kind of control.
But what if I'm just investing for the long term and don't have a specific date in mind?
In that case, a bond fund might be a better choice since they constantly update their holdings as bonds mature and new ones are added. You don't have to worry about managing maturity dates yourself.
So it sounds like bond funds are more of a set it and forget it type of investment. Now, how about diversification? We touched on that earlier. How does that play a role in deciding between individual bonds and bond funds?
As we talked about, diversification is super important for managing risk. If you're buying individual bonds, you need to buy a lot of them from different issuers to really spread that risk around. And that can get really pricey and time consuming, especially if you don't have a ton of money to invest up front.
But with a bond fund, you get instant diversification since the fund holds all these different bonds already.
Exactly. You get exposure to a much wider range of bonds, all with one investment. So if one bond doesn't perform well, the others can help balance it out.
That's a big advantage.
Okay.
Let's talk about costs. I know there are fees involved with both individual bonds and bond funds. How does that work?
You're right. Individual bonds typically have transaction fees when you buy or sell them. These fees can vary depending on the broker. And the type of bond funds, on the other hand, have what's called an expense ratio.
So an expense ratio, that's an annual fee that covers the fund's management costs.
That's it. So individual bonds have upfront costs and bond funds have ongoing fees. You have to weigh those depending on your strategy.
Right. It seems like how often you plan to buy and sell would be a factor there.
Exactly. If you're a buy and hold investor, meaning you plan to hold your bonds for a long time, those transaction costs on individual individual bonds might not be a big deal, but if you're trading more actively, those fees can really add up and cut into your returns.
So if I'm constantly buying and selling a bond fund, might be better because I'm not hit with those transaction fees every time.
That's a good point to consider now. Having said all that, there are still some specific cases where individual bonds might be the way to go.
Okay, when would that be?
If you're making a large long-term investment in U.S. Treasuries, buying individual bonds can be more cost-effective, particularly if you plan to hold them until maturity.
Because you're locking in that interest rate for the entire term and avoiding those ongoing transaction costs.
Right, but for most other situations, especially when you're looking for diversification, convenience, and lower transaction costs, bond funds are generally the better choice.
So unless I'm planning to invest a large amount in treasuries for the long haul, bond funds are probably the way to go.
That's a pretty solid rule of thumb.
That's helpful to know. Earlier, we were discussing Vanguard's suggestion to shift to a 40-60 portfolio. If someone is listening to this and thinking, hey, maybe I should rebalance my portfolio, how do they actually go about doing that?
Well, before making any big changes, it's really important to take stock of your own financial situation, your goals, and how much risk you're comfortable with. There's no magic formula that works for everyone.
You have to find what's right for you. So what are some of the things people should be thinking about when they're making these decisions?
Your time horizon is a good place to start. How long are you planning to invest this money if you're nearing retirement? You might want to be more conservative and lean towards a larger allocation to bonds, but if you're younger and have more time to ride out market ups and downs, you might be okay with a higher allocation to stocks.
So your timeline really dictates how much risk you can handle.
Exactly. And you also need to think about your personal risk tolerance. Some people are naturally more comfortable with risk than others. There's no right or wrong answer here. It's all about what you can stomach.
Right. It's about finding that balance between risk and potential reward. Now, you mentioned time horizon and risk tolerance. I imagine your specific financial goals also come into play, right?
Absolutely. Are you saving for retirement, a down payment on a house, your children's education? Those goals will all factor into how you divvy up your assets.
Wow, this is a lot to consider. Seems like talking to a financial advisor might be a good idea for people who aren't sure how to navigate all of this.
I definitely agree. A financial advisor can help you assess your individual situation, create a personalized plan, and choose investments that align with your goals and risk tolerance.
All right, great advice. Well, this brings us to the end of this segment. But before we sign off, I want to remind everyone to like this video and subscribe to the channel. We'll be diving deeper into the bond market in the next segment, so make sure you stay tuned. Welcome back, everyone. We've covered a lot of ground on bonds already, but there are a couple more things we need to touch on.
Right. There's more to this bond story.
Exactly. Let's talk about yield curves and how inflation really impacts your bond investments.
Both super important. Let's start with those yield curves. You hear about them all the time, but they can be a bit of a mystery.
I'll admit, I see those charts of curves going up and down, and I'm never quite sure what they're telling me. What's the basic idea here?
A yield curve is just a way to visualize interest rates on bonds with different maturities. But it's important to note that we're talking about bonds with the same credit quality.
So we're really just looking at how time impacts those interest rates. Longer-term bonds versus shorter-term bonds.
You got it. And what's cool is that the yield curve at any given moment gives us a glimpse into what the market thinks about future interest rates.
So it's like a snapshot of market sentiment, specifically about where rates might be going.
Exactly. Think of it this way. A normal yield curve slopes upwards. That means bonds with longer maturities will have higher yields than those short-term bonds.
Which makes sense. If I'm locking up my money for 10 years, I'd expect a better return than if I only commit for 2 years.
Right. Investors want a higher return because they're taking on more risk with those longer-term bonds. But sometimes you see something called an inverted yield curve.
Okay, so instead of sloping upwards, it slopes downwards.
You got it. Those short-term interest rates are higher than the long-term rates. And historically, this has been a bit of a red flag.
A red flag for what?
A potential recession.
Oh, wow. Why is that?
Well, when investors think the economy is heading for a downturn, they tend to buy up those long-term bonds.
Because they're seen as safer.
Right. And that demand drives down the yields on those bonds. Remember, bond prices and yields move in opposite directions.
Higher bond price, lower yield. Got it.
And at the same time, you might have the Federal Reserve raising those short-term interest rates, trying to keep inflation in check.
So then you end up in this situation where short-term rates are higher than long-term rates, and the market is basically saying, hey, we think rates are going to fall, fall, probably because the economy is weakening.
Exactly. It's not a perfect predictor, but investors watch it very closely.
So how does knowing about yield curves help me make smarter decisions about my bond investments?
Well, if you think a recession's on the horizon and interest rates are going to drop, you might want to make some adjustments to your bond portfolio.
Shift towards shorter-term bonds, maybe?
Exactly. Those won't be as affected by those potential interest rate declines.
Got it. Okay, so that's yield curves. Now, what about how inflation impacts bond investments? We talked about TPS, but I'm guessing there's a broader impact than just those specific securities.
Definitely. When inflation goes up, interest rates usually follow suit. Lenders want to be compensated for the fact that their money will be worth less in the future thanks to inflation.
So if I buy a bond with a fixed interest rate and then inflation goes crazy, I'm essentially losing purchasing power.
Right. Those interest payments just won't buy as much.
So when I'm picking bonds, I really have to think about what I think inflation is going to do.
Absolutely. If you're in an environment where you think inflation is going to be a problem, you have a couple of choices. You can go for those TPS, those inflation-protected securities like we talked about, or you can zero in on bonds with shorter maturities.
Because when those mature, you can reinvest at higher interest rates, which are likely if inflation is still high.
Exactly. You've got to be flexible and adapt to the current economic situation.
This has been a fantastic overview of the bond market.
Yeah.
Any last words of wisdom for our listeners as they navigate this complex world?
A few things to keep in mind. First, diversify, diversify, diversify. Just like with stocks, you want to spread your risk by investing in different types of bonds, different maturities, different credit qualities, different issuers.
Don't put all your eggs in one basket, right?
Exactly. Second, be honest with yourself about your risk tolerance. Are you okay with a little volatility in hopes of getting those higher returns? Or do you want that safety and stability of those U.S. Treasuries?
Know yourself and invest accordingly.
Right. Third, think about your time horizon. How long are you investing for? That's a big factor in deciding what kind of bonds make sense for you. And finally, stay informed. Keep up with what's going on in the economy, interest rate forecasts, all the things that can impact those bond investments.
This has been so helpful. Thanks for breaking it all down for us.
My pleasure. I hope it helps everyone make smarter decisions.
I know it will. And to all our listeners, don't forget to like this video and subscribe to our channel for more in-depth conversations about all things investing. We'll see you next time.